Greetings and welcome to this video. My name is Kevin Matthews and I am the tax professor. Class is still in session because remember that learning never stops. And so today we're going to talk about a very interesting topic. This is actually a topic I get from a lot of clients, and so I'm really excited to actually talk about this and hopefully refer some clients to this if they ever have any questions. But we're going to talk about traditional IRA withdrawals. And so usually what ends up happening is the majority of people usually have 401ks, and some of these will apply, some of this will apply to 401ks too, but we'll keep that into a separate video in and of itself. But for the traditional IRA, what ends up happening is the way that it works from a tax perspective, you put money in, you get an immediate tax deduction off of it. What ends up happening is when you take the money out after you retire, you then have to pay taxes on the withdrawals that you have. Now this is much different from a Roth IRA, which is a different vehicle where there is no tax deduction in the beginning, but once you withdraw the money, you get to take everything out tax-free. And that includes both contributions that you did, but also earnings. So needless to say, if the client's very young, we generally recommend that they go with a Roth IRA. And then if you have a whole bunch of traditional IRAs and you're very, very close to retirement, usually we don't make a whole lot of recommendations. But every case is specific. Please remember, don't take what I just said and say, okay, well, I'm 20, I must do a Roth IRA. There may be something special in your case that we need to take into account. And so if that happens, obviously I'd like you to reach out to me if you have it. Feel free to reach out to me, and you just go to my website at www.betasolutionscpa.com. That's www.betasolutionscpa.com, and you can reach out to me at any time and talk about it. But if you're saying, Kev, I really like you, but I really don't want to talk to you about this, that's fine. Go talk to your tax professional. Just make sure that your tax professional fits into one of three categories, and that's either that they're a CPA, an EA, or a tax attorney. You want to make sure that they fit into those categories, because if they don't fit into those categories, what ends up happening is you may be getting bogus advice, and so we want to make sure that you're getting professional advice in order to do that. So when we're trying to talk about traditional IRAs, and look, a very common traditional IRA is usually one that most people have where they could deduct, and it changed every year, but it was like, $4,000 or $5,000, maybe $6,000, depending on what your age is. And so these were very popular a lot younger, a lot earlier. And so, because what ended up happening is you had a lot of control in how your IRA money was done, as opposed to a 401k where the trustee really controls, what your options are. And for the most part, most of the trustees don't give a whole lot of options. I remember when I did my 401k, before I started my own company, and now I control everything. Basically what ended up happening is I was given probably about 6 funds to choose from, and that was about it. And if I didn't like those funds, I was stuck. With the IRA, I could pretty much go on the open market and choose a wide range of investments, and so that's one reason why the IRAs are very popular. Your traditional IRAs not only include those, however, but there's also another IRA called a SEP IRA, and we'll talk about that in another video, but it basically stands for Simplified Employee Pension IRA. And then there's also something called a simple IRA, which is kind of akin to a 401k, but it's a lot less regulatory, but also there's a lot of other great benefits that you can get from it. And so, if you're a business owner and you want to talk about that more, feel free to reach out to me at our website, and I'll be happy to go over that with you. That's an area that I do a lot of consulting in for people. Okay, so the first thing we're going to talk about is early distributions. If you take out money before you are 59 and a half, there's several reasons that you can actually do it and not incur a penalty. So for example, you could do it for education expenses. You can make it as a down payment on a new home if you're a first-time, if you were what's called a qualified first-time home buyer now. Again, first-time home buyer has a very unique meaning, and we won't go into that in this video. Again, if you need to reach out to me in order to figure that out, I'm happy to help out. But there's definitely, you can use some money in your IRA for a down payment up to certain limits, and we can go over that with you. Or you could do necessary living expenses if you retire early. Any distribution will be fully taxable unless non-taxable contributions are made. And so what ends up happening is, say for example, you're one of those people who's very fortunate. Maybe you went to law school, you made a lot of money, and you made too much money that when you made contributions to a traditional IRA, those contributions were not tax deductible. Well, here's the thing. The IRS has this concept called basis. We talk about this more on the business side, actually, just because it's generally something that we need to deal with on businesses. But basis is essentially pre-taxed money. So if you didn't get a tax deduction from it, the IRS can't go back and then tax you on that money so long as you can trace that appropriately. And something that we run into a lot in this industry, there's a lot of people who don't track that appropriately, and as a result of which they lose thousands of dollars of taxable of tax savings that they're just kind of thrown out to the window. And it's like a tax-free, it's like a donation to the federal government. There's ways to be able to save some of that money, but you have to be able to reach out to one of us, a CPA, EA, or tax attorney, and then we can go through those steps with you. In addition, distributions before 59.5 may be subject to a 10% additional tax penalty. This is kind of was put into the law to kind of discourage people from taking money out premature to retirement, but then they had like sort of the exceptions that they kind of put in. So if you want to take the money out and you're not 59.5 quite yet, this is, you can do it outside of the normal programs, but you're going to take a penalty hit on that. And so there's ways to avoid that. And again, feel free to reach out to us to discuss some of those. But some of the ones that we're going to talk about in this video, there's actually where you can do a substantially equal periodic payment system that gets set up. That's not something that you want to fool with on your own. Okay, you want to make sure that you're definitely, and I would actually talk to somebody who has IRA knowledge and experience in dealing with those. I've actually done them for a few clients. I've been beneficial to get those. They don't happen very often because most people that they're not going to retire until they hit 59.5. But this was the couple that I had. A couple of these that I had were people who were able to retire early because of they had actually, I think both of them had government jobs, and so they were retiring early because they had hit their limits on working for the federal government. So another aspect we want to talk about with traditional IRAs is naming beneficiaries. Basically, what happens is you want to make sure that you're hitting this topic correctly, and the reason why is because if you don't choose the beneficiary correctly, you can leave a massive tax headache for the person that you've just signed as your best beneficiary. And there are certain ways that we can do these so that those tax headaches can be minimized, but then also allow for you to leave for in case you pass away earlier than you expected in retirement. I mean, it could happen. God forbid that there's a sudden illness or something of that nature, and that happens. But you want to make sure that the beneficiary gets chosen correctly, and CPAs, especially those who specialize in estate law, and I do have actually quite a lot of experience in that area. I would be happy to talk to you about that in further detail, but that's more of a one-on-one conversation and not really appropriate for a video. A third aspect that we want to talk about with IRAs is that at some point you're going to probably have what's called required minimum distributions. Now, mind you, required minimum distributions, sometimes also referred to as RMDs, they only apply in traditional style IRAs. So for example, if you have a SEP IRA, a simple IRA, or if you have a traditional IRA, once you hit 70.5, you're going to be required to take these payments out over time. And if you don't take the payments out, what's going to end up happening is you're going to get a tax of about 50%, and that's pretty nasty. Okay, and if you're late doing that, there is a way that you can get it to where you can ask the IRS for forgiveness, but it does require that you have to work through somebody who's licensed to practice before the IRS, which is again those three titles that I asked for that you use: the CPA, EA, or tax attorney. Generally, we can help you into to getting that if that happens. Again, This is what I would call the mea culpa rule. It's not, you know, hey, you know, this is the 10th time I've forgotten it. I just need to ask the IRS for forgiveness. You know, the IRS is, you know, their generosity goes very, it goes only a little ways. But then, you know, they understand that stuff happens, and that's why they have this where, you know, if a CPA says, yeah, you know, I agree with them, it wasn't their fault or it wasn't intended, there's definitely some ways that we can help out with that. Now again, we always want to tell the IRS the truth. Don't be making stuff up when you're talking to the IRS, because it will not work out for you. So if you think it's easier to put money into an IRA than to take it out, you're absolutely right. Managing how you're going to take distributions from a traditional IRA actually can be a very challenging task, and so we want to make sure that when you do it, that we're keeping up on the current laws. And again, this is something that we do all the time, so this is something that we spend a lot of time with, and I'm happy to talk about this in other videos. If you have a request to talk about any of those topics or any other topic that we talk about in any of these videos, feel free to leave a comment in the boxes below, and I'm willing to talk about it. I mean, you know, some of these topics that I'm coming up with in the videos that I've done, you know, they're just, you know, they're just topics that I've run into in the office that I felt that, you know, instead of somebody driving all the way out to my office and sitting down with me and asking this one question, we could have all saved probably about 4 or 5 hours of and them stress, because they're thinking that they've done something wrong, by just having an opportunity to look at a video and find the answer for that. I want to thank you for watching these videos. My name is Kevin Matthews, and I am the Tax Professor. Class is going to still be in session because the learning never stops. I want to say thank you very much for watching this video. Again, if you have any questions that you want to leave for the public, feel free to put them in the comment box below. If you want to reach out to me one-on-one, go to my website at www.betasolutioncpa.com. That's www.betasolutioncpa.com, and I'll be happy to reach out to you as soon as I can. Again, thank you very much.